I'm here, 3 p.m. We start our Saturday education program. So here on our YouTube channel, and you can see on our YouTube channel, let me bring you YouTube channel. All right, I think folks are seeing YouTube channel, right? Grace, folks are seeing YouTube channel? All right, so this is our YouTube channel, folks, and everything we talk about, including what we're doing today, is going to be on YouTube channel. So you can always come back and go to Community CPA under YouTube channel and find us, subscribe to our channel. Once you subscribe, you'll get notification from us to tell you what we're talking about each time. So today's topic is a great one. It's the one that we come through all the time at the tax filing season. Right now, and we have clients coming in, goes, I made too much money and help me reduce taxes. That might be too late just because you're coming in at the tax filing time. If you knew you are going to make money in 1 year like a windfall, especially for the folks who are not making the same amount big money every year, making 1 year big money is really kind of cringe your gut, right? You're like, I just made that money and I will pay so much taxes. It seems to be really detrimental, and I understand that feeling. But when you do make money year after year at a certain amount, and your senses are getting used to the taxes you pay. I mean, the reality is the more you make, the more taxes you pay, right? That is, I'm only going to lie to you saying, oh no, some people don't pay taxes even though they make a lot. You may be giving me President Trump as an example. I'm not his accountant. I also don't know how he does with his life. And just looking at media, doesn't sound like he's doing the right thing. So I'm not going to comment about that. But the reality is, the more money we make, the more taxes we pay. But when you have a windfall in 1 year, say every year you just make $50,000, and then suddenly 1 year come, you got something happen in your life, and you got this $1 million payment. You're like, don't know how much taxes I'm going to pay. If you are in that situation, ladies and gentlemen, you really want to come to your CPA. I'm not saying you come to Community CPA. Welcome. I want you to come to Community CPA, but you need to go to your professional CPA person and let them know that before the year ends. Do planning and knows what you can do to minimize your tax, right? So today, I bring to you examples. And of course, I don't have all the examples in the world, but I have examples from the practice over the past 27 years. So I'll tell you what people are doing and how that would be different if they did certain things prior to getting this money. So let's go about that. And I have a PowerPoint prepared to guide me in this whole journey. So I will be focused and, bring to you just exactly what you need to know today. I made too much money this year. See, I say this year. I didn't say I make too much money every year. If you make too much money every year, ladies and gentlemen, congratulations. And you know how to do your taxes. You probably is already with us. All right, about our firm, this is always something I want to brag about because I want to give you that dose of confidence in our firm's ability to handle your tax situation. And we have more than 26 years practice history. So, we have more than 10 languages collectively spoken by our staff. That just means we're a very diverse group, right? You find us from every continent on earth, and we are a lot of us, not all of us, a lot of us are immigrants for the first generation, just like myself. I immigrant from China to Canada and from Canada to US, right? And we serve more than 10,000 clients. I didn't really count. Last time I counted was about 12,000. Then I haven't really updated, so our slides always say that we have more than 10,000 clients worldwide we serve. And we have 4 branches currently. In Iowa, we have 2. Minnesota and California. We also right now working on open up Houston, Texas branch in June of 2024, which is this year. And we're already in the month of March, so there's a lot of work to do still yet. So, about myself, I have served on National Taxpayer Advocacy Panel, and which is advisory committee to IRS for 2 years. And I also wrote 2 books so far. I have 4 books in the pipeline that I need to write, but these 2 came out. I'm writing the 2 p.m. right now. And 8 a.m. starting up your business, 10 a.m. grow your business. So these 2 books are filled with stories of our clients and of course my own too. So you can read and understand the journey of entrepreneurs here in US as myself, the first generation of immigrants. So I didn't really have parents and teaches me how to do business at the dinner table. I don't understand what is line of credit. I don't understand what is the debt and loans. And are you kidding me? I grew up in the place. Loan is not even a word. It's not even in the vocabulary of my childhood. So I don't understand things like that. But, and in this practice had taught me so much that I want to give that back to you. So these are the book I'm writing. And the 2 p.m. is how to expand your business beyond yourself. This is more of our journey, right? Community CPA started, in 1998, and we grew throughout the time. And now we are at the place where we're expanding beyond me and expanding with multiple partners inside of the company. So that's a journey of expansion. 6 p.m. is the last book in this journey, which is to sell or retire from your business. I don't really have any content for that one yet because it's a little early for me to think about it. And someone was saying that, how much you wrote in the 6 p.m. I said just 1 page and a couple letters saying no retirement. So that's what's in there right now. So just so you know, it is a life story of my clients or you and me. So it is not a textbook. It's not boring. It gives you the story. All right, no responsibility disclaimer is so important. This is a free education we want to bring to you. Doesn't mean that everything is absolutely correct and anybody can litigate with the result. But what we're saying is that we give you our thought, what we know at this time, and you take the education and do your due diligence and make sure you apply that properly, okay? And don't just blindly believe internet. Internet is it's just a junk place, right? It's like you go into the consignment store. You're just going to look at a lot of things. Garage sales, you look at a lot of things. But what you're going to pick as jewel and make a lot of money out of it, it is your due diligence. You want to pick the knowledge that you know and understand. You always need to engage professionals to work your work instead of just taking, cut and paste out of the internet and making up what you are doing. That may be not something I advise you to do. Today, I have several stories I want to tell you, and let's look at these stories. These are stories in real life, ladies and gentlemen. John came in, had over 450 sheets of W2G. You know what that is? That's the gambling win. And total gain summed to be $860,000. Stacy received $1.6 million settlement for work injury. Amanda cashed out company-paid stocks for cash value of $500,000. Maggie received $1 million from her mom after her mom passed away. And Craig sold his insurance agency back to American Family, and he got paid $450,000. Julian received $500,000 to start a project, but the material got delayed, work was not done. These are all big numbers, am I right, folks? And you got these numbers in 2023, you're like, I don't know how much taxes I'm going to pay. So let's go through each one of these. And I, really don't have a lot of write-up, but I had a point to remind myself and then to talk to you about. So let's talk about John, okay? And John has always known to be the risk taker. So he did a lot of business in the past, and from telephone store all the way to nail shop and all kind of things that he did. And this particular year he came in, and these are stories from what we know, but not necessarily for 2023, but you just want to understand the concept. He came in and brought in 450 sheets of W2G. What does that mean? That means he has won that gambling and for 450 times. That's why he got those sheets. And we have 365 days in the year. Can you imagine how many times he devoted himself to the gambling ground? Oh yeah, he made a gain of 860,000. Of course, John can file 860,000 gambling gain, then go to itemized deduction, put in the losses. But can he put in losses more than what he gained? No. The most he can put in was 860,000. And he also need to have a very accurate record of what exactly the money he put in. But what John was saying is that, Ying, this is not good because I literally lost a lot more. I probably lost about $1.3 million to get this $860,000 gain. I don't think it is right that I don't get that loss to be deducted. Maybe not right now in this year, but I should be able to carry my loss to next year because I'm doing this like a professional gambler. So ladies and gentlemen, what is professional gambler? Professional gamblers are the gamble people who does it full time and make money for purpose. Does John qualify to be professional gambler? If we look at his tax return, he actually didn't have any job that year. And he was in and out Las Vegas, and then between the gambling, the state gambling one, I forgot the name of it. So he was traveling in between, and then he gambles whole year. And so in his own word, he said that he actually was gambling to make money, and he does it not just once a day. He does it 365 days every day in the gambling ground. He studies the machine. He even showed me the diagram of the machine that he was doing and which one makes what money. And he has a record of which machine didn't win. And he thinks that he can go in there and do more and get more money back from there. Are you convinced at this time? Believe that for that particular year, John at least is a professional gambler. What professional gambler does? File Schedule C and 1040, right? Of course, John can form a company to do this professional work. Then he needs to put in his $1.3 million money he has in the company as an investment and then start gambling, then write off the losses. So with that definition of professional gambler, of course, John would be able to write off the losses. So in this particular case, and John actually lost more than what he made. So he doesn't need to pay taxes, period, and he also have losses that can carry forward to the following year to pay for his gain. And knowing the history of John, the following year he actually made a lot more money in gambling than what he lost. So with the little loss carried forward to the next year, plus the investment, the losses he had, he still paid taxes on about $450,000 gains. Income gains on this one. So it's a regular income tax, so he did pay taxes in the following year. But this is the year where John received the money, and it did make $860,000 gambling gain, but because he qualifies as a business person doing gambling, professional gambler, so he actually can deduct his expenses and then carry the expenses over to next year when he made it big, and he pays back his loss and pay income tax to IRS. With that said, let's look at another example, a story of Stacy. So Stacy received $1.6 million settlement from work injury. All right. So when you injured at work and you can't work anymore, so the work will continue paying you income, right? They're still paying your salary. And very typical if you have work comp, if your company has work comp injury payout, it's a third-party payment to your W-2, so you still get W-2 like you are still working. Those are the income coming from the injury. These are taxable income. So Stacy was injured. Out of this 1.6 million, I don't remember the breakdown, but there are three kind of payment is in here. Number one is the medical bills that she already incurred that was paid back. Number two, it is the physical injury payout, like pay for pain and the suffering. The number three is actually the money that she pays to the attorney, the settlement. After it's settled, the attorney get a piece of income out of there. All right, so just want you to know that the income piece that Stacy got is taxable. Not all of the settlement is taxable. Then you may ask me that which part of 1.6 million should be accounted as income. Like I said, the portion that pays to you as if you still can work, that is taxable. Normally, those kind of money can be paid to you gradually, right? They don't have to assume you're going to be handicapped for 10 years, so let's pay your income in lump sum in 10 years. You can actually negotiate that with the payer to have that come out to you every year as an income, so you can lessen your big income tax bill and then making that every year income. Am I right? And you understand our tax rate is going from what? 0% to what? To 40%? 37.5 plus investment tax rate is like 40%. So you want to avoid that. You want to avoid making big dollars and paying so much taxes. But if they're coming as a steady stream for you, then you won't end up paying that top rate, right? You might even end up not paying anything because you're below the income threshold. So what can Stacy deduct? Is legal fee paid to the lawyer deductible? And you would think yes. Actually, no. Just depends how that legal fee was structured. So you could negotiate it with your lawyer to make sure that before they disperse that payment to you, they take their fee. So the insurance company, when they pay the amount over to the law firm, because they're the one fighting for you, and the insurance company's payment would be going to the law firm, and the law firm give you just a portion that you have, and then not the lawyer's fee, right? This is something you can make arrangement. In Stacy's case, the insurance company paid the legal fees to the lawyer directly and paid Stacy to Stacy's portion. So even though Stacy goes, I got a lot of money, 1.6 million settlement, but if you look at it at her bank account, she only got about 60% of that 1.6. So a lot of that, she never received it. So when you report income, are you reporting 1.6 or are you reporting the cash portion she received? You want to go by what she received, especially you want to go by with the 1099 miscellaneous that was issued to her by the law firms, right? So with that said, when Stacy comes around to us, goes, oh, I'm so worried about I'm going to pay so much taxes. I have $1.6 million settlement. Our immediate reaction to that is to understand the mix, the make-up of the 1.6. Which portion is what, then you can plan that. And if it is not yet becoming the final settlement, you can even help Stacy, or Stacy can help herself to go back to the law firm and to talk about how to structure this payment so it doesn't pop into her bank account with 1.6 million. Then he has to write almost 400,000 to the law firm. All right, so that is about Stacy. Let's look at our next one. The next person, remember, that was Amanda. Remember, Amanda and has a very gainful employment, and her company pays stock, and she can sell the stock on the open market and sell them, and so get that money cashed in. So that's what she did. She has these stocks of her company, and she's still employed there. She's not going anywhere. She just wants to sell some of those. So she sold for $500,000. Now, the 1099B came back to Amanda. It didn't have the cost base. Amanda come around and goes, now what to do? Because I have 500,000 capital gain and I want to know what to do. And I only had the option to exercise. As soon as I got that to exercise, I accessed it. So it looks like it's a short-term capital gain. And now what am I going to do, right? It is so really depends on how Amanda received that stock. A lot of times, when company give you the stock because you worked here for 1 year, you worked here for 2 years, and when the company do that to you, on your W-2, you should already see how much the company is calculating the basis to be. That is showing up on Amanda's W-2 from last year. So we actually got the W-2 from last year and look at the breakdown to know how much per share was. Because when they give you the share and they did a favorable base, selling on the open market, it was $55, but the company gave to the employee of those shares at $20 per share. So Amanda has a basis of $20, and that $20 times number of shares already showed up on her W-2 as additional compensation. So Amanda's base salary was only $50, but last year her W-2 shows about $100,000. So with that said, you know that Amanda got a whole bunch of shares. Now the market goes up. It's not 55 anymore. It's actually 60. So if Amanda sells these shares, her gain is $40, not 60. Am I right? So this 500,000 she got has a portion of that belongs to the basis, which she already paid taxes for. So this is where we want you to be so aware of your money. It doesn't mean that you got a big bunch of payment. That means you're going to pay taxes on every penny of it. And you actually need to know what you did with the base. It is very possible that your employer is giving you the stock with zero base. Just give it to you. Zero base. Okay, in our firm, and when we give out shares to partner, it's zero base. Because we don't ask for anything, people don't pay for anything, right? But in some companies, they do. They evaluate their shares. They say, well, my share worth $500, and I give you 2 shares, and give me $1,000. And of course, you don't give to the employer $1,000. What the employer does is to take the $1,000, put it on your W-2 as if you received the money. You didn't. You just received the share. So this is where the Amanda story comes. So Amanda actually was selling these shares, and if she could sell the one that just awarded, which has a higher base. She could also sell the one that awarded before had a lower base. Just depends on her situation today, how much she wants to pay on capital gain. Is this something she wants to do or she wants to pay less? So that is a calculation. Am I right? So in reality, what we found out is that although Amanda has the $500,000 gain from this exercise of a company stock, and Amanda also does trading on her own, and so she also have capital loss that saved over there, and she forgot about it. So really, at the end, Amanda didn't pay much of a capital gain because this $500,000, it was offsetting a lot of the losses that she already has in her 1040 from prior. So there is a story of Amanda. So give you some thinking about, if you got a windfall and your company just closed and they gave the stock to you and you can sell them, or you just left your job and you don't want to keep their stock and you want to sell it. So these are all become windfall for you, and you want to carefully consider the base, carefully planning the rest of your life, right? So you could plan to sell off your lost stock to cash in the capital loss to offset this capital gain, right? So there's so many things that you can do. So I'm just leaving that thought with you, knowing the possibility it is the best gift I can give you. All right, what about Maggie? We talked about Maggie, right? Maggie got a $1 million, big amount, and from her mom. Mom passed away, so she got $1 million. Normally, these type of inheritance at the federal level, no taxes, because mom is not so ultra wealthy, so her leftover wasn't like $40 million. So you get estate tax going on mom's estate. And the mom did file estate return to conclude the life, but no tax due. So the bank account, $1 million, come to Maggie. And Maggie worried, wondering how much taxes she's going to end up paying. And Maggie lives in Texas. And in Texas, there is no inheritance tax or estate tax. So the state actually repealed that tax back in 2015. So with that said, Maggie pocketed $1 million free. There should be no worry. So when Maggie came to us so worried, we explained. Then Maggie said that, oh, what if I live in Iowa? Because Maggie moved from Iowa to Texas a couple of years ago. So she was playing what if. So Iowa has inheritance tax. But the exception is, if that is mom to children, as long as it's a lineal ascendant or descendant, like mom, children, it is blood related. And you don't have taxes on inheritance in Iowa. So even if Maggie lives in Iowa, she would still get that for free. So this is where when you get money from elderly, from parents, and think about it. But if you're in Iowa, and this is just the money you got from the neighbor's lady who died without children, and you were the nice neighbor, always taking care of her, so she left her $1 million for you, and you live in Iowa, then you will pay. You will pay taxes on that. But if you live in Texas, there would be no taxes on that. So those are the differences, that when you are knowing you have big money coming in, maybe it is time to move. I'm just kidding. A lot of times you'll find ways, okay? And Maggie didn't really move for that $1 million. She moved because it was time to move to Texas. All right. So our next story is Craig. Remember, Craig is a businessman. And Craig owns an insurance agency. Some of the insurance agency, we call them captive agency, means that if you're an agent for American Family, for example, and you would have to sell American Family's product, American Family grow your agency with you, for you, but when you retire, you sell, the American insurance company actually would purchase your company back, because they will give the purchase to another new agent, or have the other new agent work out the deal with American Family. So this is what happened to Craig. So he really cannot just sell the business anywhere he wanted. He sold it back to American Family, so he got $450,000. Okay, and when you have a business sale, I want you to remember that the business sale, how much you pay on that profit, has a lot to do with what's on your balance sheet. So for example, Craig, as an agency, he actually has a small property on the agency account, because after he became American Family agent, and he bought a little property, really small house but it's a commercial property, to run his agency in there. So that property, when he bought it, he put it under his S Corp. So he has American Family S Corp operation with the property inside of the S Corp. So the selling of the $450 actually doesn't have anything to do with the property, but has a lot to do with the name, with the client list that he developed. So this $450 is based on the client list. So if you're saying that, client list has no value, Ying, there's no basis, he's gonna pay capital gain for this whole thing, that is probably correct. Because this $450, American Family would not say that this $450 including the house, what they use the house for. They don't need that They don't need that agency. They don't need that property. But what Craig can do is to sell the agency property and this 450 list of client list together. And then the property has spaces, and the plus, even if there's no base for the client list, then he will have the capital gain calculated properly, right? So he's not giving away his property. He carved that out. 450 is the only money that he needs to claim as capital gain. But you have a selling expense. So what is your selling expense? I'm pretty sure American Family has a legal team to work for Craig, so there is an additional charge to that, so he would have to reduce that out of the 450, right? And what if Craig didn't want to finish this work and he sell this 450, then he go ahead and buy another one, which is an advertising company. So the like-kind exchange things is only applied to real property. So he can do that for his little office, but he can't do it for client list. So even if he bought an advertising company, then you want to advertise, you want to amortize and depreciate what you bought on the advertising company, but your 450 is still gonna be something that you pay capital gain. But remember, all of these taxes are coming into 1040 for Craig. So if you have a portion with 450 capital gain, then you also have a Schedule D that with a capital loss, or you also have the purchase of a new company and where you did a big bonus depreciation, you got a losses. So these are offsetting all of these gains. You don't necessarily end up paying big taxes to the amount you sold. And here I also put in an exemption of $10 million to just draw your attention. You need to know that. You need to know there is exemption out there for certain type of company to qualify for that. So when you sell for $15 million, you walk away from $10 million gain. And that is the section 1202. Not every business qualifies for that, and Craig's insurance agency do not qualify for that. That's why we do not apply for that, but we look at his basis carefully. And we look at his other businesses carefully to make sure that overall, and Craig didn't end up paying the $450,000 capital gain, which is long-term because he had the agency for more than 1 year, and the long-term gain, so he didn't really end up paying the maximum taxes that normally would be paid. So that is a business sale. When you have a business sale, my advice to you is you never should sell your business without consulting the professionals. I know you are so smart, you are so professional, you're so good with what you do, but that doesn't take away from the fact that you are not trenched into this area of practice day in, day out, like people who lives inside of community CPA. Very simple. And we breathe the community CPA's air. This is part of our life. If you make me cook and I'm not a good cook, right? But if you're talking about things that I consider that to be my profession, then of course we should be better. We should know more. And the same thing with you. You're running an insurance agency. You know so much more about insurance, but you may not know what all entails when you sell your business. So that is Craig's story. Our last story, but not the least, is Julian's. Julian is a very successful construction company CEO. And he received $500,000 in 1 year. Don't remember which year. And that project, 2020. So what happened is the project payment received, but the material did stop coming. So he could not get the job done within the year that he does his tax return. So this $500,000 become a pure profit for that year because he couldn't get material, so nothing, he couldn't spend on the material either because he couldn't get it. And then the work wasn't done. So in this case, Julian come over, goes, well, I'm going to end up paying a lot of taxes, because I have this 500,000, I don't even have a chance to spend. There's no way I can even do anything with it because, the supply chain was completely cut off. There's no supplies. Should he pay taxes on the 500,000? Several ways to think about that. So this is what I missed. When you run a certain type of business, sometimes the payment that you are getting, it is not exactly the revenue you earned. You haven't even earned that. Another good example would be subscription business. You know how people are doing those online trainings? Like you pay for the fee first, then the participant would go through a couple months and finish the training. And you charge $12,000 for the whole year, but really, the participants is doing the learning every month. If they do not do the learning every month, your policy says that you will refund them. So that means your $12,000 is not income. You really have to expense that. You really have to take it in as an income and 1 month at a time to see who actually took the training. Am I right? And maybe there is a person paid you $12,000 but doesn't come in 2 years later. That $12,000 is not earned revenue. It's your liability you need to pay back to your student. So Julian, same thing. This $500,000 he got, it is not his income. Because if customer just goes, well, it's too late, I changed my mind, and give me back the $500,000 because you haven't really bought any materials, didn't do anything, and that's what it is. What should Julian do? Julian would just have to pay it back. Can you imagine Julian paying taxes already on it? That would be so wrong. And whoever did that accounting and taxes for Julian, they are not professionals. They're not. And the real accounting for construction company should be done by percentage completion, or at least put yourself in the accrual method, right? So that you can actually account that $500,000 as unearned revenue that you didn't earn. It's your liability. So Julian should not pay any taxes for this $500,000. So this is the windfall for Julian. Julian thinks that, oh yeah, I got $500,000. No, you didn't. You just got $500,000 new debt. You haven't really done anything for your customer. So with that said, I want you to realize that how that goes with a big lump sum money, right? It's not exactly, oh, every penny need to pay taxes, ladies and gentlemen. All right, now we got this example going. I know I made you thinking right now, but what about other things? Ying, do you have any other things to tell us? And when we have a big lump sum payment and ended up paying too much taxes, I do have a couple of things I want to just bring you awareness of. And one thing is about tax credit. So what is tax credit? And I have many webinars about tax credit I want you to take a look at. If you go to our YouTube channel, you type into tax credit, you'll bring up all the tax credit topics I talked about. I highly encourage you to just listen through it. I don't care you watch it, but you listen through it, because while you are driving, and just listen to me, I am not going to make you jump, so you're safe at driving. But listen to it, just bring awareness. Bring that buzzword into your regular thinking when you think about your finance. So the benefit of tax credit is, if you can get a tax credit, even if you end up with a tax bill, that credit will offset your tax amount, make it smaller. The common tax credit for business nowadays, R&D, is a very big one. I actually just had a client, I was just talking to this client today, and they have a windfall income, and they did not know how to deal with it. But they also had the business have a very large R&D expenditures. They didn't make money, so they didn't really think about R&D. But now they got a big windfall, and they really should think about the R&D. So with that said, and I want you to, go, I'm not going to spend my time to explain to you how R&D works. I have webinars in our YouTube channel to explain in detail how it works. One of the webinar is called Chicken Farm R&D, and that is a question and answer with the client about the R&D credit. It will really make you understand what that is. So those credit, R&D is one of them, work opportunity credit is one of them. If you hire people to work and they're coming from welfare, they were on government welfare, you bring them out of welfare, or if you hired veterans, so you have a work opportunity credit, which is huge. Work opportunity tax credit means that a percentage of your salary you paid to these people will reverse your taxes. We're not talking about deduction, income, expense deduction. We're talking about tax dollar offsetting tax dollars. But this credit calculation is not something from a complicated percentage. It is a chunk of your expense become a tax credit. Okay? And how to claim the tax credit, how is the claiming tax credit would help me with my big bill? That's your question, right? So if you ended up with a $100,000 tax bill, but you also have tax credit of $100,000, your tax liability and the check you write to pay taxes is zero. You don't pay taxes because you have the credit, right? So that is one area I want to emphasize to our entrepreneurs. And you need to know that tax credit is your friend. And maybe they are speaking foreign languages to you. Well, you just have to be like community CPA, speak all kind of languages. Tax credit is your friend. Make a friend even if they don't speak English. Of course they speak English, but their English is so awkward. If you read them, it's getting you very confused. So you just go to our YouTube channel. I do not speak complicated English. I don't have the ability to speak complicated English. And my Chinglish is very well understood by 6,000 people out there who follows me. So you can be that one too and understand what I am saying and do your research, right? And there is also another one which is called, it's also important in terms of if you got big windfall and you wonder how to reduce your tax liability, and the way to do it is to do a tax planning. I can't tell you how important that is for tax planning. People don't think tax planning is necessary. You think you just plan it in your head. No, I can plan it in my head, but not everybody else. If you are not in this profession and you really could not do it properly because there are so many things, so many changes, and there's so many variety of ways to think things through, and you want to be engaged with a capable person and a firm to do your planning. When you plan ahead of time, there are ways to make it happen so you don't have this tax bill. But if you don't plan it ahead of time, you just come to me to file taxes on April 14 and the 15 is our due date, that is a tall order for any tax professionals. Because, there's a lot of things we won't be able to do. Time passed. So knowing that you're going to have a windfall this year, knowing that you're going to be in that situation, plan. I have a client, and she knew that she's going to get about $43 million. No, $430 million coming in due to the sale of the equity inside of her company. And we are on regular discussion for that same scenario just because things are changing, her thought is changing, And then the more we learn of her, the more we have ideas. So the planning already started, even though we don't even know when is the closing day yet. Could be this year, could be next year. But look at how proactive people are, and you need to be one of those. Okay? Tax planning, and typically in our firm, if you're our client, you know that our tax planning season is start from October and at the end of December. And when you want to do the planning, if you don't do it regularly with us, you need to approach us because we don't know you need a planning. We do planning for our regular client that we knew that we do it every year, or clients who had a living trust set up with our firm that we know that to renew their living trust, so we meet them every year. So those are regular things we do. But if you're not one of those and you just need to do tax planning because you know you happen to got a lot of money in 1 year, afraid of tax consequences, you need to start before the year end. All right? So I just want to remind you that and say that so hushly. And you remember, because if you don't plan ahead of time, not a lot of things we can do. And the more you make, the more you pay. That's just how it is. But the more you make, the more plan you do, the more efficient your tax will be. So that is the approach we take. Now, this concludes what I want to transfer you today. And I'm downloading my knowledge to you today. And this is our website, right? If you want to know more, you can go to our website, communitycpa.com. And these are the partners we have. Every one of us specializes in different areas. And you can have me. And if you click me, you will see my calendar that made open to you. And you can book my time and come online. I have not had anyone who will come online, talk to me, and ask that, Ying, I think you didn't teach me anything. I wasted my time and money, and refund my money. No one ever in my 27 years practice. So here you go. I want you to take the opportunity, tap into the knowledge that we have, and really know that you are the one making your tax liability reasonable. It is your job. We are assisting. But if you don't initiate, no one can really know what's in your life and what's in your head, right? So with that said, you know you can also email Catherine at communitycpa.com. And our phone number, yes, we open 6 days a week. What do you think? Yeah, we're a whole bunch of workaholics. And not all of them, but some of them for sure is workaholic in Community CPA. You can contact us. We were proud to be workaholic. There's nothing wrong with it. Better than otherholic, right? We will talk to you again and see you on Tuesday. Bye-bye.